So I believe that Mwalimu is audible. So basically, I'll want to introduce basically the concept of advanced taxation. So about advanced taxation. Of course, this is for the specific semester of December, who are preparing to do their exams in December. So literally, when you're talking about advanced taxation, I believe that I'm very audible. I can see Kimani, I can see basically to be. So looking at this concept of advanced taxation, you'll find that it is a very interesting area, because first of all, you know very well that these are specialization paper at this level. Advanced taxation is a specialization paper, right? Specialization. So meaning that once you've decided that you want to specialize in tax, that is to say, you are in love with tax. So you'll find that at this level of taxation, basically, the basic concepts that we had at our basic level will come in very handy at this level. Anytime you're talking of advanced taxation at this point, the knowledge that we had at our basic level, it will be very important for us at least to have a clue or try to remember what we did, because it is a basic knowledge that we had. It is the same knowledge that we're going to use at this point here. So it is very vital and very important that we have this basic knowledge. So to this point, talking of advanced taxation, you'll find that we will be expected to cover 9 topics. By the time we are through with everything, we will be expected to cover 9 topics in advanced taxation. So looking at that case, you'll find that it will be important. It will be very, very important for us to recall all that we did, at our basic level. Topic number 2, my good students, what will you be expected to cover in topic number 2? Topic number 2, it is the longest topic in our basically course. Topic number 2 is the longest topic in our course. And this is a place where you'll find that even for the examination purposes, it is an area where, if at all you talk of computation, it will constitute almost to 50% of whatever computation that's going to be tested. So topic number 2, we are saying that it is a very, very important topic that you should be very keen with it and make sure that you have grasped each and every concept in this topic. Topic number 2, my good students, is literally what you are talking of limited companies. Limited companies. Remember, limited companies, basically, they are quite wide, because at this point, we'll be expected to understand that now, because you're specializing in tax, of course, you will be expected to be consultants outside here. So there are some various elements that you just have to be very good at. Number 1, you should be able to learn, basically, and having that idea of how to compute the tax of a company. Remember, practically, we normally tend to talk about what, of course, the IT2. So you'll find that these are some of the concepts that you must always be able to understand. For you, yes, you're having this company. How are you going to prepare these books for taxation purposes? At this point, you'll find that at the same time, it will be very important for us to be able to understand. You're having a company. I'm having various subsidiaries. I know probably in your FR, you've talked of consolidation, right? As probably reporting all these subsidiaries as one. But now, for tax purposes, how then are we supposed to look at it in terms of taxation? Also, there is other key element that majority of the students, they normally tend to ignore, but is very important, the concept of shortfall. We find that I will be having the concept of basically taxation of dividends. Taxation of dividends is literally amongst what we normally term them as what? Taxation of other sources of income. So you'll find that if at all you're to look at topic number 2, is quite wide. Charitable institutions. Talk about taxation of petroleum activities. All of these, we are going to find them basically in topic number 2. So that is to say, topic number 2, we've agreed that this is one of the longest topic that we'll be having. So in that case, we'll at least you'll find that we'll take a bit of time in topic number 2. So after looking at that case, my good students, if I told you to proceed to topic number 3, a very practical area, again, topic number 3, this is a concept of value-added tax administration. Value-added tax administration. Value-added tax administration. Value-added tax administration. So at any given point in time, when you'll be looking at the concept to do with VAT, I know we are not very new on VAT, right? I know we are not very new on VAT, and currently, of course, there's that discussion which is ongoing whether we should increase our VAT or not, right? So you'll find that these are not a new concept. So the additional element that we'll be having here in VAT at this level, it is where I'm given basically the restricted component, right? So it will also be upon us basically to restrict our input taxes. That's the only new component that you're going to add at this level of VAT, whereby I'm given the restricted component, restricted input. When I'm having such, how am I supposed to account it in VAT? You'll find that will be the only additional item that we'll be covering at this level here, that is under VAT, which is topic number 3. So after that, you'll find that currently, we know very well that there are some career agents, they underwent kind of a paramilitary course, right? So that they should come to each and every door. So long as it's a business, they'll always tend to visit there, right? So what are they doing? They want to make sure that there's a very kind of, there's a high compliance, basically from taxpayers, right? So you'll find that in this event, maybe you've been having a client. This client will be, maybe Ringo, or maybe Kimani, or maybe Fred, or maybe Tobias. I've received basically an assessment from KRA. How will you be able to assist me? So it is upon you basically to analyze this assessment. If at all you're having a clear knowledge of taxation, and then you should advise this client. This is an opportunity for you guys. So you'll find that tax knowledge can literally give you money if you want, right? So at this point, topic number 4, Actually, it is always a very interesting, it's always a very, very interesting topic because we'll be looking at it practically. And this topic is what we're referring to as a tax investigation, right? Talk about tax investigation. A very interesting area, a very interesting topic, whereby in this case, you'll always tend to hear clients like, hey, nimerambwa this time. Ama unapata, you've been given assessment from KRA. Such case, what will you do? Or rather, in this case, maybe you want your tax compliance, you're having an issue with KRA. Right now, our president gave that component of tax amnesty. You as a tax consultant or you as an individual, a good student of tax who wants to apply this knowledge, how will you assist your clients in terms of getting this tax amnesty? You'll find that this topic, literally topic number 4, is always a very, very interesting topic. If at all, you just approach it with an open mind. A mind that basically at this point, you're not just doing it to pass exams, but you're doing it to gather that knowledge which you can use outside here. You'll find that it is a topic that will literally give you knowledge which you can use that knowledge to earn money. So that is tax investigations. Topic number 5 here, 100% theory. And basically, whenever we are looking at this aspect of topic number 5, we can take a good example of Keroshe, right? Keroshe breweries. At this point, of course, they are given a lot of maybe aspect, if at all, you can say the aspect of the assessment was too high. But there are some other ways that these guys could have sorted this issue. Probably it was one of the parties was not cooperating. And that's the reason why it went, or rather it is at this level where it is. At times, even if you're having a client, my good students, never allow that tax matter to reach basically tribunal, or maybe to reach basically the aspect of you guys kind of now you're sorting it out of this agreement. You'll find that also these KRA guys, they're also people, right? They're also human. You can literally explain yourself. You can literally basically sit down with them and have an agreement. Instead of you being called, or rather you've received an assessment, you are like, mimi sitaenda. You are ignoring them. And the moment you are ignoring them, you'll find that literally they're also humans and they're doing their work. They'll be like, Tobias don't want to cooperate. Iman doesn't want to cooperate. Fred don't want to cooperate. Maybe Alice don't want to cooperate. And in this case, if you don't want to cooperate, of course, they'll take it further. But if at all you have received this assessment, or maybe you've received a call from them, a compliance check, just avail yourself. If at all you've been doing some tricks in your books, of course, with an assistance of whoever who normally assisted you, or rather normally assists you. So just approach them, right? Have a sit down with them. They're also human. Sit down, agree. And in this case, you'll find that you'll always, or you can, set these cases within, not to allow it to go at a level whereby maybe you're being taken to court. And these are an interesting and also a very important knowledge that you guys must always tend to possess, because at this level, you'll be looking at what you're referring to as basically aspect of tax dispute resolution mechanism. Tax dispute. Of course, resolution mechanism. Resolution mechanism. A very interesting area. And many a times at this level, you'll find that our approach will literally to look at things on a very practical angle, right? Because at this point, I'm taking you guys that you have decided that you are specializing in this. And whenever you're talking of specialization, that is to say, it is not for these exams purposes, rather for knowledge. Because once you have it right, you'll find that it will be very, very easy. It will be very, very easy for us to do it. It will be very, very easy for us to apply this concept in a practical environment. So kindly, as you are doing this, I want us to have that mentality that, you know what, we are not doing this for exams. We are doing this for knowledge. And that's why you are specializing in tax. That's why you decided that you want to take tax. So in our classes, at times, we'll be setting some practical session whereby I'll be guiding you guys on some few areas which I'll find important for you to understand them practically and also to do them hands-on. So that at this point, by the time you are through the paper, at least you'll also be having a clear knowledge, a clear understanding. And in addition to that, you should be having at least skill on how you can apply these concepts in the practical environment. So that is topic number 6, tax dispute resolution mechanism. So this topic, as I've said, is purely theoretical, but very interesting. We know very well that this will never miss in exams, more so whenever it comes to theory. So after that bit, you've done all these items. Now you need to advise your clients. In this case, that should take us to topic number 6, where we are talking about what tax planning. Tax planning. We understand that right now economy is at where it is, and businesses, of course, will always want to save. And other ways of saving, basically, it is if at all they use the legal loopholes available to reduce their tax liability, right? Not evading tax, my good students. They should not evade tax, right? But you should use the legal loopholes available to assist your clients basically to do what? To reduce their tax liability. Legal means available, and they are there, and you're going to learn. So that is what we'll be looking at mainly under tax planning. So you'll find that by the time we are through with tax planning, you can literally sit down with your client and, of course, guide this client on some specific ways that he or she can use to do what? To reduce his or her tax liability. So you'll find that that will be very important for us to always pay keen attention on what we'll be handling here under tax planning. So after that case, looking at topic number 7, topic number 7, of course, will be expected to cover. That is, of course, that is aspect of aspect of we can talk about taxation of cross-border activities, taxation of cross-border activities, taxation of cross-border activities, taxation of cross-border activities. At this point, you're having Eliud Kipchoge. Maybe at this point, they're outside here. They're outside there. They have basically run. They have kind of they have their goal. In this case, remember, goal is not just an item, but this is cash that they are getting. So at the end of the day, these are literally Kenyans. So where they have earned their income, of course, if it is in London, this income has been earned within the jurisdiction of London. So what will happen? The authority will demand something from Kipchoge. Coming to Kenya, KRA will be there watching you. This is what you've earned. And basically, this is what you've earned. You need to give us something. So you'll find that as at the end of the day here, we are looking at this individual who is earning an income outside Kenya, and basically, and also he has also some other incomes within Kenya. So there's that concept of aspect of double taxation. So whenever we are having this, you'll find that what basically Kenya will do, Kenya will enter into an agreement with these other countries so that such people will always be given what you normally refer to as what? The DTR, the double taxation reliefs. So you'll find that taxation of cross-border activities, it will always be about considering basically these guys probably that they do have income in Kenya, and also they are earning outside Kenya, and basically they are residents, of course, of the country. So that is topic number 8. So talking of topic number 8, basically, we'll also be talking of the aspect of a key concept here, topic number 8. It is also a theoretical part. And topic number 8, we are talking about tax systems and policies. Tax systems and policies. These are what you'll be expected to cover literally in topic number 8, tax systems and policies. So looking at tax systems and policies, at this point, whenever you're looking at maybe say like Kenya, for example, Kenya, we're having various ways which the government can collect taxes, right? Because we are talking of VAT, we are talking basically of various income tax, which will include payee, annual income tax. We're having basically the aspect of excise duties. We're having the aspect of custom duties and so many other levies. So you'll find that if at all we can look at the country of Kenya, we're having various ways of collecting these taxes. And these are what we are referring to as the tax systems. So you'll find that in Kenya, for example, we're having these are form of what we normally refer to as multiple tax system, right? A single tax system is where I'm only having one source of collecting taxes, which I'm not sure if there's a country that has a single tax system. I'm not sure if there's a country that has a single tax system, but literally if there is, you'll find that single tax system is a point whereby I'm only considering one source of course, government collecting taxes. So after that bit, that should take us to the last topic, which is topic number 9. Topic number 9, of course, would be expected to cover professional practice in taxation. So we're having a professional practice in taxation, professional practice in taxation. That is what will always be expected to cover anytime you are talking about what? Anytime you're talking about, of course, topic number 9. Because at this point, you guys, you're professionals. So there are some code of ethics that you must always tend to adhere to. So you'll find that in this context, basically, that is what you must always tend to learn again. So looking at it in this point, by the time you're done with our syllabus, we should be expected to have cleared all this. And at this point where we are standing today, we are looking at exactly 2 months for you guys to sit for your exams. So that is to say, we must sacrifice and we must always be very committed at any given point you are called upon for these classes. You must always tend to avail yourself. But at the same time, you'll find that there's a strategy that you normally tend to use in doing all this. And this strategy, of course, I know very well it will always tend to help, whereby you get access to the recorded version of the classes. After you have the access to the recorded version of the classes, you'll find that it will always be very easy for us to study in advance, so that whenever we come to class, at least we are not that green. We're having something, and basically the class will always tend to flow. So that's very important. That's very important to note. And looking at our topics here, you'll find that we also having 100% theory topics like tax planning, 100% theoretical. We're having taxation of cross-border activities as computation tax systems, 100% theoretical. Professional practice in taxation, 100% theoretical. So literally, these are theory. They are marking T, these are theory. But you're not saying that theory is not important. Theory is very important because for your exams purposes, you'll find that theory will constitute almost up to 40% of what is going to be tested. So that is to say, regardless of these topics being theory, we must also be very keen on them. Looking at that case, we'll also be having these other topics. So that will leave us with roughly like 6 topics computation, right? And 6, actually also topic number 5 is theoretical. Also topic 5 is theoretical. So literally this will lead us with 5 topics which are computational. Out of these 5 topics, my good students will find that the longest topic that will take us time basically is topic number 2. And for the purpose of your exams, all these topics are always tested, literally. Computation topics, many a times or always, they'll always tend to be tested, probably except for cross-border, which you might be tested in relation to the theory part. So that is to say that for tax, you have to be hands-on on some of the specific items. And literally, you'll find that the strategies that we'll be using to do all this, I'm very sure it will help us a lot. It will help us a lot. So mentioning that, in that case, Mwalimu will want to introduce the component of taxation officially. And looking at tax, of course, as much as it is advanced, we're going to start from scratch, looking at the basic concepts, what you must always tend to have in mind, what you must always tend to basically understand as we proceed. So you'll find that ideally, we are going to start from the backbone, or if at all you can term it, from the heart of tax, So that is what you are having in relation to basically the overview that you are dealing with. After talking of that, I'll also then introduce this component of tax. But before we go to topic number one, introducing it, before we go to topic number one to introduce this bit, I want to take us to basically the basic concepts of taxation, or rather, if at all you can say, the backbone of tax. So allow me to erase this point, believing that all of us, we have literally taken this down. So looking at tax, saying that you must be having strategy. So that is also to say that there are some specific areas and concepts that you must always tend to have at our fingertips. Excuse, what are these items, my good students? So term them as basic concepts. Or heart of taxation, if at all you can term it. Heart of tax. Or backbone of tax. There are these key elements. That you must be having in your mind as a student doing advanced taxation at this level. So what are these elements? Number one, my good students, a must-know concept will be for us to be able to understand what you normally say, or rather to normally tend to talk about. This is 1A, taxable income and non-taxable income. That is number 1A. The same concept will also relate with allowable expenses and non-allowable expenses. Very key. Allowable expenses and non-allowable expenses. Allowable expenses and non-allowable expenses. Number two key element, my good students, that you must always be having at this point is the concept to do, of course, with approaches of determining taxable income. Talk of approaches of determining taxable income, whereby we normally tend to talk of two approaches. The first approach, reported profit approach. And number two, basically, we normally term it as what? The gross profit approach. You must know these approaches, because these are the approaches that will literally guide us at any given point whenever we're preparing our books. It will guide us to understand what point should I use this approach, and at what point should I use this approach. So making it one of the most important area. After doing that, number three, at this point, advanced stage, you must be very good with the knowledge of incomplete records. Incomplete records. Because many a times, yes, it will come as a part of working in your books, but it will literally guide you a lot more. So whenever you're talking about taxation of partnership, you'll find that the knowledge of incomplete records will come in very handy. You must be having it at your fingertips. Number 4, we are talking about the concept of capital allowances. Capital allowances will be very key for us to be able to understand, because you'll find that as much as it is not given as a topic in this level, but you'll find that the concept and knowledge of capital allowance will always tend to affect us in each and every computation that we're doing for tax. So that will make it also one of the most important concepts that you must always be having at your fingertips. That should take us to number 5. Number 5, of course, at this point, we should be expected to have a clear understanding on what we are talking of: taxation of other sources of income. Taxation of other sources of income. Taxation of other sources of income, ideally, this will entail the aspect of dividends income and what? Interest income. Interest income. Very important concept. Very, very important concept. And finally, here we will be talking of the concept of VAT, which the beauty part of it, it is part of our topics at this level. So about VAT. So my good students will find that this is what we'll always tend to have. This is what will always tend to basically be required to have at any given point, at anywhere where you'll be handling tax. If it is CATNEB, if it is NEC, if it is KESRA, at any point where you'll be doing tax in this Republic of Kenya, you'll find that this knowledge, once you are a master in this concept that Mwalimu was written here, and that's why I'm terming it as heart of tax, right? That's why Mwalimu is terming it as heart of tax, heart of tax, heart of tax. Literally, we know very well that Kimani, if your heart is not functioning well, ama if your heart stops, utaendelea kulishi kweli? Kimani, saizi roho isimame, utaendelea kuishi kweli? Tubii, roho ikisimama saizi unaendelea kuishi? Of course itakuwa ngumu sana, right? Ama for example at this point uvunje backbone. Ukivunja backbone, you'll find that again it will be very, very hard for you to basically move. So that's why we're also saying that the same concept with tax, if at all, and this one I'm going to tell you for free, if at all this knowledge you're having an issue with this concept, trust me, tax will also be kind of it will also be kind of very difficult to understand. But if you are a master of this, if at all you've decided that, you know what, I want to master these concepts, you'll find that tax will always be very, very easy. Tax will always be very, very easy. So looking at this, therefore, this is where we are going to start from. The aspect of the basic concepts of tax. The aspect of basic concepts of tax. And doing this, these are what Mwalimu is going to do. We are going to start, of course, with the concept of taxable income and untaxable income. And I'm going to share this in our groups so that we have this, literally, of course, later on when you get time, you'll go through it. You'll go through it. So these are what I need to share. Let me share this in our group. I'm also going to share you on our screen so that all of us, we should be having it. We are starting with the first concept or basic concept of tax. Mm-hmm. Let me share here on the screen as well, so that we have it right as I'm sharing it on the group. I'll also take you through, guys, quickly, so that when you have time, of course, you'll go through it at your own time. But most importantly is we understand it fast. So I'm looking at just a moment here. Kindly confirm that you have received on the group. Kindly confirm that we have received on the group that document. Kindly confirm that we have received on the group that document. Yes, 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 yes. Confirm that Mwalimu should continue. Mani, have you received that document? It's saying no.
Yes.
Taxable. Hey, so not yet. Funny. Oh, I've seen the reason why. Just a moment here. I'm not sure it is not. I'll just check it. I'll mean that we have just to put it down. As I'll be looking at a clear way of doing that. So looking at the first concept of taxable, we are just going to write in brief, but I'll share the documents at the same time. So taxable income concept, taxable and non-taxable income. So what we need to understand first of all is that whenever we are talking of taxable income, if I told you to start with this, and we'll be giving some example, taxable income. So my good students will find that at any given point in time, whenever we're talking about taxable income, literally, these are incomes that are supposed to be subjected for tax purposes, or rather incomes that will be subjected for tax purposes. And of course, you are talking of business income. So talk about income subjected for tax purposes. Income subjected, incomes subjected. These are basically incomes subjected for tax purposes. These are what you're referring to as a taxable income. And what are some of these incomes that we'll be talking about here, my good students? Some of the incomes, we're just going to list some of them. Number one, you'll be talking about basically, of course, these are normal business incomes, like maybe aspect of, we can talk of normal business income, or basically profit from trading activities, right? From trading activities. At any given point, whenever we have such income from trading, of course, you'll find that then these incomes should be subjected for tax purposes, and therefore being termed as basically taxable income. Number two form of taxable income that we can also literally talk about. In this case, you'll find that at any given point, whenever we are having basically talk of, we can basically talk of reduction in provision for specific doubtful debts, reduction in provision for specific doubtful debts, reduction in provision for specific doubtful debts. These, of course, will be taken as a part of our basically aspect of taxable income. Because at this point, you should understand that, of course, you're going to analyze it, but talking of that specific item, these are what you must always tend to have in mind. These are what you must always tend to have in mind, my good students, that any point in time, whenever we are talking of bad debts, we normally tend to talk of, number one, bad debts written off. Bad debts written off. Bad debts written off, as later we'll be seeing this. This is literally an allowable expense as it is, but you're going to look at it. This is literally an allowable expense. Basically, expenses that the taxman has granted you permission to deduct from your income. The same concept the other concept of bad debts, you normally tend to talk about provisions. Provisions for bad debts. Under provision for bad debts, my good students, we normally tend to talk of two. The first item here, we normally tend to talk about general provision. General provision for bad debts. Number two, we normally tend to talk about specific provisions for bad debts. Let me give you the difference. Whenever we are talking of general provision, take for example this case. We are saying that maybe 20% of tax students, I'm expecting 20% of tax students not to clear their fees, not to clear their fees, right? Not to clear their fees, not to clear their fees, not to clear their fees. So I'm having 20% of tax students not to clear their fees. Get this concept clearly. The other statement we are having is, I'm expecting that, say, Marion will not clear 20% of her fees. This is the point that I want to drive here. Provision is all about anticipating. Provision is always about estimation. Provision is always about estimation, is always about anticipating. So I am anticipating that 20% of tax students will not clear their fees. General provision, which in this case, it is non-allowable expense. It is non-allowable expense. We'll be looking at that as we continue. And note that very well. Specific provision. Marion will not clear 20% of her fees. This is specific provision. And specific provision for basically tax purposes, we normally tend to take it as what? Allowable expense. We'll be looking at these items, allowable expense and unallowable expense. That's why Morimo was saying that it is very important and very key for us to know that. So this is what will happen. At times, we could be having if I told you to start with general provision, I could be having an increase or I could be having a decrease. For general provision, I could be having a decrease or I could be having an increase. So an increase in general provision for bad debts, my good students, an increase in general provision, an increase in our anticipation for general provision for bad debts. This is non-allowable expense. Digging further, that is non-allowable expense. And literally, we're going to look at it amongst the list of non-allowable expenses. Talk about decrease. Decrease is non-taxable income. Decrease is non-taxable income. Decrease in general provision for doubtful debts. That is non-taxable income. Very important. Talk about specific here. Specific provision. Specific provision, by now I know you guys have gotten the clear picture of what specific provision is. So for specific provision, again, I'll be talking of two: increase and decrease. If I told you to talk of increase in specific provision, this will be taken as allowable expense. If at all we are talking of decrease, this will be taken as basically taxable income. Taxable income. And that's why you are saying that reduction in provision for specific doubtful debts to be what? To be part of our taxable income. So that's the concept of bad debts that will be experiencing, and that will be will be always, anytime you're doing a paper, you'll find that that concept must be there, or many a times you'll find that it will always be there. So that will be very important, and I want you guys to make sure that whatever that we've written here, it has literally synced at the back of our mind, because that concept is very, very key. The concept of provision, mtaiona kila swali tuona enda nayo, tuona patana nayo hapa na pale, na hapo ndo mwalimu atakuwa anatuuliza, guys, are we dealing with allowable expense or non-allowable expense? That will always be our song. Allowable expense, non-allowable expense. Allowable expense, non-allowable expense. That will always be our song. Number 3 item, we can talk of trading, receipt, and balancing charge. Yeah, trading receipt. Trading receipt literally will occur when we'll be looking at capital allowances, where I am having an item, we are disposing all assets in a particular class, and probably my business is in operation. It will give us trading receipt. I am disposing all the assets in a particular class, and our business is still is ceasing. I'll be having balancing charge. This one basically will be looking at it as we continue. The other item here, my good students, we'll be talking of these are, of course, these are income that are taxed further, right? Talk about non-qualifying dividends and incomes. Non-qualifying dividends and incomes. This one you find that they'll form part of our taxable income as well. They form part of our taxable income as well. These are literally some of the investment income that you're talking about. So I'll share more concepts or more details in relation to this, but the whole idea what Mwalimu wanted us to understand is that at any given point, whenever you're talking of taxable income, just understand that these are incomes that will be subjected for tax purposes. Incomes that will be subjected for tax purposes. And I've given you some of the list and some unique items here. These are must-know concepts. These are must-know concepts. You don't have a shortcut there. You don't have a shortcut there. You don't have a shortcut there. This will take us to, this was 1A, 1B, non-taxable incomes. Non-taxable incomes. Non-taxable incomes. Very important to note. Non-taxable incomes. Again, it will be key that we understand the whole idea behind non-taxable income, even before we jump to maybe some of the examples in relation to that. It is vital that we do understand when we are talking of non-taxable income, basically, what are we talking about here? What are we talking about here? What are we talking about? So non-taxable income, my good students, and this is very key, we are looking at incomes that will not be subjected for tax, or incomes that were subjected to a final component of tax, which is withholding tax. So key items here, because the whole idea here, we're looking at what? Non-taxable, these are business income, right? So we're saying that these are incomes that will not be subjected for tax, or incomes that were taxed at source, and that tax was a final tax, and that tax was final tax, and that tax was a final tax. That tax was final tax. So what are these non-taxable incomes that we'll be talking about here? Number one, we are talking of part of this other investment income. Investment incomes, I'm going to list them. Investment income that we'll be looking at here. Example, we are talking of qualifying dividends and interest income, qualifying dividends and interest income, qualifying dividends and interest income. Number two, these are basically, of course, we are talking of investment incomes received from abroad, investment income received from abroad, investment incomes received from abroad, investment incomes received from abroad. And the specifically that we're talking about here, basically, these are interest and dividends earned from foreign country. Dividends and interest earned from foreign country. Number three, we can talk of gain on disposal of a fixed asset. Gain on disposal of a fixed asset. Gain on disposal of a fixed asset, gain on disposal of a fixed asset. So you'll find that today you've decided that you know what, you want to sell that car of yours, or rather maybe you want to sell that land of yours. And in that case, you're going to have a gain on whichever transaction that you'll be making. So this gain literally, yes, it is a gain, but it's going to attract a final tax, which is, of course, basically a withholding tax. So you'll find that rather a final tax, actually, which you are terming it as not withholding per se, but capital gain tax. So you'll find that, yes, it is a gain that you've earned, but already it has been taxed specifically at a special form of tax, which is CGT. And therefore, whenever you're looking at it in our normal business activities, I'm not going to take it as part of what? As part of our income. So gain on disposal of fixed assets. Gain on disposal of fixed assets. Gain on disposal of fixed assets. The other item you can talk about here, I've already talked about it. Decrease in provision. Decrease in provision for doubtful debts. Decrease in provision for, decrease in provision, decrease in general provision, actually. Decrease in general provision, decrease in general provision for doubtful debts. Decrease in general provision, doubtful debts. Decrease in general provision for doubtful debts. Very important to note. And some other non-taxable incomes, which you have it in our list, which Mwalimu is going to share. So these are some of the non-taxable incomes that we'll always tend to talk about, To that point, probably, anyone with a question? Tobias, do you have any question up to that point? Tobias, you can unmute, then you tell us, then you mute back. Any question?
I'll ask later.
Great. Kimani, any question? Any question? Kimani, rest, believing that you're okay. So in this case, you'll find that concept of taxable income and taxable income. Let us dissect allowable expenses and non-allowable expenses. Let us dissect allowable expenses and non-allowable expenses. So talk about allowable expenses here. Allowable expenses, allowable and non-allowable expenses. I want this concept to sink in very well. I want this concept to sink in very, very well. So when we are talking of the first one, allowable expenses here, when we are talking of this first element, allowable expenses, what will come at the back of our mind? So in a very simple term, allowable expenses are expenses that are deducted. Allowable expenses are expenses that are deducted to reduce the income to be taxed. Allowable expenses are expenses that are deducted to reduce the income to be taxed. The income to be taxed. Of course, these are expenses that the taxman has given you right to deduct from arriving at the income that you're going to tax. Say, for example, these are what allowable expense will have. This is the impact of allowable expenses. Assuming you're having basically your income here, you're having your income. Having your income at this point, there are these expenses that you're going to deduct. These are now what you're terming them as allowable expenses. So the taxman has given you right to deduct these expenses from the income that you want for us to arrive are the income to be taxed. Mark it very clearly that these are the expenses that taxman has given you right to deduct from your income to reduce what? The income to be taxed. To reduce the income to be taxed. These are what we're referring to as allowable expenses. These are what we're referring to as allowable expenses. A good example, of course, these are what? Normal business expenses. Normal business expenses. Example, when you're talking about maybe rent, right? These are operational expenses. Talk about rent, water, electricity, probably transport that you're having, right? Normal business expenses that you're having. Normal business expenses that you're having. Talk about number 2, bad debts here. Bad debts written off. Bad debts written off. We had a look at that concept because these are actual. These are actual. Number 3, we can talk of specific provision. Specific provision. Specific provision for doubtful debts. 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 By now, I know when Mwalimu is talking about specific provision, we all have an understanding of what specific provisions are. We all have an understanding of what specific provisions are, right? Number 4, of course, we can talk about legal expenses. But legal expenses, with that category, my users that I've listed for you in that note that I'm going to share, not all legal expenses are taken as allowable expenses. Not all legal expenses are taken as allowable expenses. For example, maybe today I've breached a contract and I've been sued as an individual. You'll find that in this case, by me breaching the contract, that legal expense that is covering that, in this case, you'll find that it is not going to be taken as non-allowable, or rather, it's not going to be taken as allowable expense. At this point, probably, I've gone to a club, someone, or rather, I'm owning a club, someone has come, as we have taken a picture in that club. The club has posted this picture without the consent. You see, they are going to be sued, and therefore, of course, these are fines they are going to pay. So, these are component of legal expense that is not allowed. The taxman will say, no, that was as a result of you breaking the law. So in this case, you're not going to have, or rather, you're not going to give you, we're not going to allow you to deduct it from your income. Fine. I'm driving somewhere, basically around town. Basically, I've parked in a wrong area. This parking probably fine that I'm going to pay. What will that be? Form of, yes, legal, but ideally, in this case, you'll find that it is not going to be allowed from our allowable expenses. So literally, these are expenses that we're looking at. Yes, expenses, we have incurred them, but ideally, they are not going to be used to deduct our incomes. Very important to know that. Very, very important to know that. So I'm having a note, or rather the note that I'm talking about. You'll find that it has a list of all the allowable expenses, and it is not only for exams but also for practice, because even if you are applying this knowledge practically, these are some of the things that you need to consider. You need to understand that, are you talking of allowable expenses or are you talking of a non-allowable expense? So you'll find that it is very key for us to always consider that. It's very key for us to always consider that. So make it one of your priority. As we are starting this, make it one of your priority that you must be able to grasp all these concepts. One will ask Mwalimu, what about non-allowable expenses? That should take us to non-allowable expenses, my good students. Non-allowable expenses. What will this entail? What will this entail? What will this entail? Non-allowable expenses here. What will non-allowable expenses entail? We can notice somewhere and say that these are expenses. These are expenses. These are expenses that are not supposed to be deducted. These are expenses that are not supposed to be deducted. These are expenses that are not supposed to be deducted from the income generated, 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 to arrive at the income to be taxed. To arrive at the income to be taxed. These are expenses that are not supposed to be deducted from the income generated to arrive at the income to be taxed. Full stop continuation, you can add and say, if they have been deducted, if they have been deducted, if they have been deducted, they should be added back. If they have been deducted, they should be added back. If they have been deducted, they should be added back. If they have been deducted, they should be added back. So, in this context, you'll find that many a times these are what you must always tend to come and realize as at the end of the day, that you normally tend to have financial accounting profit and you normally tend to have tax profit. These are two different items. We normally tend to have financial accounting profit and we normally tend to have all the tax profit. So what will happen? The financial accountant probably will take some of the expenses that you don't recognize in tax. Example, maybe depreciation here. Example, maybe I'm talking of depreciation. Accountant will take depreciation as an expense in arriving at the accounting profit. For us in tax, we don't recognize depreciation. So therefore, if it was deducted, I need to add it back. I need to add it back. And that will depend on the approach that you're using. Other expense maybe here we can talk about, maybe the aspect of purchase of fixed asset. These are just but example, purchase of fixed assets. Today I've purchased a motor vehicle. The accountant probably has taken that as part of my expense, whereby he has considered it in arriving at our accounting profit. In tax, I don't recognize this purchase of motor vehicle at all as an expense. So if it was deducted in arriving at the accounting profit, we are going to add it back, because literally you realize that us deducting this expense will reduce the income to be taxed. And this is not benefiting the taxman. The taxman wants to earn as much as he can from a legal activity. So you'll find that in this sense, if at all I have deducted motor vehicle as part of my expense, and literally you know very well that motor vehicle probably at this point, it is not an expense. What will happen? We have to add back that expense. So that's what you're talking about. What? That's what you're talking about. The aspect that we're referring to here as basically the aspect of financial accounting profit, tax profit. Talk about non-allowable expense. The other item may be, I'm having a loss on disposal of fixed asset. Having a loss on disposal of fixed asset, in this case, accountant might have considered it in arriving at the accounting profit. But for us in tax, we don't recognize that. For us in tax, we don't recognize that. So therefore, how are we going to take that? We are going to take it as part of basically non-allowable expense. Very important. And the list goes on. The list, basically, you'll find that the list is too long. In that case, with what Mwalimu will share, of course, you'll have that list. You'll have that list clearly. You'll have that list clearly. Just a moment here. So basically, Moni is saying that, of course, we'll have this list and you'll find it to be very, very interesting because we have given all these elements. That was our first basic element that we should be having. The other key point, my good students, that we should also tend to understand, remember, these are the foundation. These are foundation of tax. These are foundation of taxation, which at any given point, you must always be having them at your fingertips. Let us proceed to the other segment, which we are referring to as taxation of other sources of income. Taxation of other sources of income. That is what I want us to look at now. Taxation of other sources of income. Taxation of other sources. Taxation of other sources of income. Taxation of other sources of income. And ideally at this point, the whole idea that we are talking about here is a concept of dividends income and interest income. That is what we are talking about, dividends income and interest income. So you'll find that, and you'll be my witness as we continue, in each and every question that we'll be handling, my good students, in each and every question that we'll be looking at, there will always be that component. There will always be that component which will be tested in relation to either dividends income or interest income. There will always be that concept which will always be tested. So that's why we are making it one of the most important concepts that you must be having in our fingertips. That's why we're terming them as what? The heart of taxation. Because without heart, you can't literally live. Without your backbone, you can't walk unless you're on a wheelchair, right? So you'll find that these are very important concepts. Let us start with dividends income. Let us start by analyzing our dividends income. Let us start by analyzing our dividends income here. Let us start by analyzing our dividends income. So anytime we are talking about dividends income, you'll find that it is categorized into three. Dividends income for tax purposes is categorized into three. Or rather, for tax purposes, dividends is categorized into three. Number one, we normally tend to talk about exempt income, exempt dividends income. Number two, we normally tend to talk about qualifying dividends income. Number three, we normally tend to talk about non-qualifying dividends income. Non-qualifying dividends income. So these are the three main forms of dividends that you normally tend to talk about. Three main forms of dividends income that you normally tend to talk about. Exempt, talk about qualifying, and talk about non-qualifying. Very important that we should understand this. Very important that you should understand this, because you'll find that it will be in each and every item that you'll be having, in each and every question that we'll be looking at. We start by exempt dividends income. Exempt dividends income. We start by looking at this exempt dividends income. What are these forms of income that you're talking about here, my good students? What are these forms of income that you're talking about here? So you'll find that the incomes that ideally we are analyzing at this point, we are looking at dividends income that are not subjected for any form of tax. Dividends income not subjected to any taxation. These are what we're referring to as exempt dividends income. Dividends income that are not subjected to any form of what? To any form of tax, to any form of tax, to any form of tax. These are what we're referring to as exempt dividends. What are some of the types of these dividends, my good students? Number one, knowing that we are looking at dividends that are not subjected to any form of tax. So examples of these dividends are, number one, we normally tend to talk of dividends from foreign investments, dividends from foreign investments. Dividends from foreign investments. And that's why Mwalimu mentioned that when we are looking at non-taxable income, we mentioned that we'll be having, yes, these investment incomes, and ideally we are talking about what? The exempt, right? The ones that are not subject to any form of tax, which we talked of exempt, right? So dividends from foreign investments. Number two, dividends received from a life assurance company. Dividends received from a life assurance company. Dividends received from a life assurance company. Life assurance, right? Life assurance. Dividends received from a life assurance. Number three components, we can talk of dividends received from a subsidiary company. Dividends received from a subsidiary company in which it controls more than 12.5%. Dividends received from a subsidiary company in which it controls more than 12.5%. In which it controls more than 12.5%. Dividends received from a subsidiary company in which it controls more than 12.5%. Such dividends will not be considered for tax purposes. Such dividends will not be considered for tax purposes. Such dividends will not be considered for tax purposes. So that is A, exempt dividends. B, qualifying dividends. Qualifying dividends. Qualifying dividends. Qualifying dividends. So what are these qualifying dividends that you should be able to understand here? What are these qualifying dividends that you should be able to understand here? We can mention briefly and say that these are dividends that attract withholding tax. These are dividends that attract withholding tax. These are dividends that attract withholding tax at the rate of 5%. Dividends that attract withholding tax. Dividends that attract withholding tax at the rate of 5%. At the rate of 5%. At the rate of 5%. And these are final tax. And this is a final tax. Being a final tax. Being a final tax. So when you are talking of it being a final tax, that is to say, it is not going to be subjected in any other form of tax. It is not going to be subjected in any other form of tax. And that's why Mwalimu was talking of the aspect of qualifying dividends. When we are looking at basically the concept that we had looked at earlier on, the non-taxable income. So these dividends, yes, you are earning them. We are going to tax them at a withholding tax at the rate of 5%, but you're saying this is a final tax, meaning that these dividends income are not supposed to appear anywhere else. These dividends income are not supposed to appear anywhere else. Examples of such dividends, my good students, will include. Examples of such dividends will include. Examples of such dividends will include. Number one, talk about dividends from public companies, public limited companies, or just public companies. Number B, dividends from private companies. Dividends from private companies. Dividends from private companies. The other number, talk about dividends from SACCOs. 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 Very important to note. Dividends from SACCOs. After that, that should take us, of course, to another element, which you are talking of non-qualifying dividends. Number 3, or C, non-qualifying dividends. Non-qualifying dividends. Non-qualifying dividends here. Non-qualifying dividends. What are these forms of dividends? We can mention something and say that these are dividends that are taxed withholding tax. These are dividends that are taxed withholding tax. These are dividends that are taxed withholding tax. These are dividends that are taxed withholding tax at the rate of 15%. At the rate of 15%, which is not a final tax, 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 which is not a final tax. I.e., that is in essence, i.e., these dividends incomes are aggregated with other incomes to be taxed further. They are aggregated with other incomes to be taxed further. They are aggregated with other incomes to be taxed further. So you're saying, yes, it is going to attract withholding tax at the rate of 15%. But again, what will happen? It is going to be taxed further. But again, what will happen? It is going to be taxed. It's going to be taxed further. Very important to note. Very, very important to know that. So, looking at that bit, examples of these dividends, literally, these are dividends received from cooperative societies. 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 That is an example of basically what you are referring to as an unqualifying dividends. So we are done with that part. That should take us to the other form of investment income here, which is what? Interest income. So analyzing interest income. 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 So again, you'll find that interest income is categorized into 3. Interest income is categorized into 3. So again, you're talking of exempt interest income, qualifying interest income, and non-qualifying interest income. So interest income is categorized into 3: exempt, qualifying, and non-qualifying. We start with the first one, exempt interest income. We start with the first one, exempt interest income. Exempt interest income. Exempt interest income. That's what we want to start with. Exempt interest income. Just like dividends, just like exempt dividends, you'll find that anytime you're talking about exempt interest income, number one thing that we should know is that these are incomes, these are interest income that are not subjected to any tax. These are, of course, interest income that are not subjected to any tax. They won't be subjected for any taxation. These are what we're referring to, of course, as exempt interest income. Exempt interest income. Exempt interest income. Looking at that, examples of such are, of course, interest. We're of interest from foreign investments. Interest from foreign investments. interest from foreign investments. Number 2, interest from post office savings bank. Interest from post office savings bank. Interest from post office savings bank. I'm not sure how active post office bank is nowadays. I'm not sure how active post office bank is active nowadays. But at any given point, whenever you're earning interest from such bank, these ones are basically exempt. These are interests that will not be subjected to any form of tax. Number 3, interest from housing development bonds. Interest from housing development bonds, subject to a limit of 300,000. Subject to a limit of 300,000. Subject to a limit of 300,000. Interest from housing development bonds, subject to a limit of 300,000. Subject to a limit of 300,000. That is to say, only up to 300 is exempt. Only up to 300 is exempt. Only up to 300 is exempt. Etc. etc. Number B, qualifying interest. Qualifying interest income. 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 We are looking at interest income that attracts withholding tax. These are interest income that attracts withholding tax at the rate of 15%. Interest income that attracts withholding tax at the rate of 15%. Interest income that attracts withholding tax at the rate of 15%. 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 And it is a final tax. 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 This statement, the next statement, if possible, underline it. The next statement, if possible, underline it, because that is the distinguished statement of all the rest. So we are saying that these are interest received by individuals. Interest received by individuals. Mark these words. Interest received by individuals from financial institutions. Interest received by individuals from financial institutions. Interest received by individuals from financial institutions. Interest is received by individuals from financial institutions. Interest received by individuals from financial institutions. Underline this keyword here. Received by individuals, and it should be from financial institutions. Example here, we are talking of course, received from banks. Category, insurance funds. Talk about anytime I'm having the treasury bills and bonds. All these are basically the aspect of qualifying interest. So long as they are received by individuals and keyword, they should be from financial institutions. Very important, very important, very important. Very important to know that. The next item here, that should be non-qualifying interest. Non-qualifying interest. Non-qualifying interest. That should be the next item here. Non-qualifying interest. Non-qualifying interest. Non-qualifying interest. So when we are talking of non-qualifying interest, my good students, what should we be able to have in mind? That yes, these are interests that will attract withholding tax. These are interests that will attract withholding tax. These are interests that will attract withholding tax. These are interests that will attract withholding tax at the rate of 15%, 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 and is not a final tax, and not a final tax, and is not a final tax, and is not a final tax, and it is not a final tax. It is not a final tax. It is not a final tax. So we are saying that if it is not a final tax, that is to say, it is going to be aggregated with other incomes and taxed further. In essence, or i.e., it is going to be aggregated with other incomes and taxed further. It's going to be aggregated with other incomes and taxed further. It's going to be aggregated with other incomes and taxed further. It's going to be aggregated with other incomes and taxed further. Very important to note. Examples of such incomes. Number one, we normally tend to talk of interest received by corporates, interest received by companies. It can be from companies also, by and from companies, right? Number two, interest from housing development bonds in excess of 300,000. Interest from housing development bonds in excess of 300,000. Interest from housing development bonds in excess of 300,000. Number three, we can talk of interest received by individuals, and not from financial institutions. Interest received by individuals and not from financial institutions. Interest received by individuals and not from financial institutions. And not from financial institutions. And not from financial institutions. Very important to know that. Very important to know that. So that is our second segment, where we mentioned that we have to understand the basics. We have to understand the backbone. We have to understand the heart of taxation. Number one, we've talked of allowable and unallowable, taxable and untaxable. Number two, we've talked of taxation of other sources of income. Number three, let us talk of the approaches of determining our taxable income. Approaches that we normally tend to use in determination of our taxable income. Approaches used in determination of our taxable income. Approaches used in determination of the taxable income. Approaches used in determination of our taxable income. Approaches used in determination of taxable income. Approaches used in determination of our taxable income. That's another item that I want us to look at. Approaches used in determination of our taxable income. Number one, we normally tend to talk of the gross profit approach. And number two, we normally tend to talk of reported profit approach. gross profit approach, and reported profit approach. These are the approaches that we normally tend to use. We start with the first approach, gross profit approach. I want us guys to grasp this approach to the point that at any given point you see a question being tested, it will also be very easy for you to identify which approach to use. So we start with the first approach, which is a gross profit approach. Let us look at this format. Let us look at this format. Format of a gross profit approach. Looking at the format of a gross profit approach. Looking at the format of a gross profit approach. Looking at the format of a gross profit approach. Okay? What do we need to know here? What do we need to know? This format, of course, I must always be having a title. So I'm having, assuming M. Darasa, Ltd, computation of taxable income for the year ended for the year ended 31st December 2022. M. Darasa Limited computation of taxable income for the year ended 31st December 2022. These are good examples that I want us to look at the approach. So just as the word suggests, we are talking of gross profit. So therefore, of course, I'll be having my value there. I'm going to have our gross profit. Believing that we all know how to determine our gross profit, right? Sales minus cost of sales. We add these other incomes, such as discount received. So that I'll be having my income here, less allowable expenses. Remember, we have talked of allowable expenses, and that's why Mwalimu was saying that it is very important for us to be able to understand the concept of allowable expenses and non-allowable expenses as well. So here, non-allowable expenses, or rather allowable expenses, I can have capital allowances. I'll have discounts. Discounts. These are discounts allowed. I'll be having bad debts. I can have provision for doubtful debts. Remember, we are talking of what specific. We can talk of maybe other expenses like rent, other legal expenses, and all other allowable expenses that you can have. So we consider it at that point. After doing all this, remember, we are deducting, right? Assuming these are total. So my business income I'll be having A minus B. A minus B. We add other taxable incomes. Add other taxable incomes. Add other taxable incomes. Such as what? Maybe talk of non-qualifying dividends. Talk about rental income. All the other incomes that you have generated, which are not probably business related. So having that, if we add other incomes from our business income, this will give us our total taxable income. Total taxable income. Total taxable income. Like that. So have that format quickly. Have that format. Have that format. Have that format. That is a format for gross profit approach. Have it before we look at what point are you supposed to use that approach. Have it quickly. Have it quickly. So you'll find that tax is always a kind of a very easy, so long as basically we open our mind wide, you'll always find tax to be very, very easy. Have it. I believe that you guys, you're done with that. So the most important question that I want to answer here is, at what point are we supposed to use this approach? That's the most important question that we need to ask ourselves here. At what point are we supposed to use this approach? This approach is best used when your examiner, when you are given required here, and you are told to determine taxable income for the year ended. Determine taxable income for the year ended. Determine taxable income for company X for the year ended. You're given there. The best, and you're not given any other further instruction. If you are asked this, the required is to determine the taxable income of company X for the year ended this year. In that case, and you're not given any other further instruction or guide, then the best approach would be this one. The best approach will be this one, gross profit approach. That will be the best approach to use if you're given this question. Determine taxable income of company X for the year ended, and you're not given basically any form of what? You're not given any form of, you're not given any other form of further instruction. So that is important to note. That's very important to note. That will take us to the second approach. Reported profit approach. Reported profit approach. That should take us to the reported profit approach. So just as the word suggests, at this point, I am looking at whatever that has been reported. Of course, it has been reported from financial accounts. Whatever that has been reported from financial accounts, that is what we need to consider. Just a moment here. So the accountant here has given us the books as tax, basically consultant or tax accountant. Now it is upon you to come up with the taxation as per the tax requirement. So we are talking of M. Darasa Limited format. M. Darasa Limited computation of adjusted profit or loss for the year ended 31st December 2022. M. Darasa Limited computation of adjusted profit / loss for the year ended at 1st December 2022. Looking at it in that case, what should we have? You're given profit by the accountant. So whatever that you're having here is reported profit. Reported profit from the books of accounts. Reported profit from the books of accounts is what you're having there. Reported profit from the books of accounts. Now you as a tax accountant, you need to adjust this profit to reflect tax profit. So the first procedure that you're going to do is to analyze what were the expenses that this accountant took and we don't recognize these expenses in tax. So you add non-allowable expenses. What are these expenses that the accountants are basically considered in arriving at this profit? And for us, we don't recognize this for tax purposes. This is what you are adjusting. Number one, accountant might have taken depreciation. For us, we don't recognize depreciation in tax, so we add it back. The accountant might have taken general provision for doubtful debts. I don't recognize this, so what do we need to do? We need to add it back. The accountant might have taken purchase of motor vehicles or purchase of fixed assets. Let me have it in general. Purchase of fixed asset. In tax, we don't recognize this as allowable expense, so we need to add it back. The accountant also might have taken loss on disposal. Loss on disposal of fixed asset. I don't recognize this, so I should add it back. The accountant, probably in this case, he had a legal fees, but this legal fees maybe it's related to breach of contract. What will I do? In that case, I don't recognize that in tax, so I need to add it back. So we are going to add back all these expenses that the accountant literally took in arriving at this profit. And that's why you're terming it as what? As adjusted profit. So first thing, we add them. The next thing to consider is what? The next thing to consider, my good students, here is in arriving at this profit, the reported profit, there could be incomes that this accountant considered. And in this case, for us, we don't recognize them for tax purposes. What do we need to do? We need to less. Take off non-taxable incomes. The accountant might have taken none or some of the incomes that we don't recognize in tax, which affected these. So we need to less. Such example of incomes, maybe I'm having, say, like qualifying dividends. Accountant just took it as dividends for us. We don't recognize that. We might have taken, say, like gain on disposal of fixed assets. We don't recognize that. And any other non-allowable, or rather any other non-taxable income. So this one we need to deduct. So that as at the end of the day, I will be arriving at the adjusted. So this one is A plus B and C. So my adjusted taxable income will be A plus B minus C. We have it there. Believing that you can clearly see the difference there. So have that format. And that's why I mentioned that it is very ideal and very important for us to know the concepts of allowable and unallowable, because you'll find that it will affect us all through. It will affect us all through. It will affect us all through. So just make sure that you're having this concept, because it will affect us all through. It's going to affect us all through. So have it quickly. We have it quickly. We have it quickly. We have it quickly. So at this point, we check at required. At what point will you be required to use this format? When the examiner here has asked us on required, determine / compute adjusted taxable income for the year ended. Believing you guys, you can see clearly the difference here, right? Determine / compute adjusted taxable income. The gross profit approach was determine taxable income. For you to use the aspect of reported, the required will be determine / compute adjusted taxable income. Adjusted taxable income. Determine / compute the adjusted taxable income for the year ended. For the year ended. For the year ended. That is very important to note. That's very important to note and consider. That's the difference, right? That's the difference. So this was our element number 3. This was our element number 3. That is to say, looking at it in that case, our element number 4, this will be what? Capital allowances. That's what I want us to start from our next class. Capital allowances. Capital allowances, or term it as investment deductions or allowances. Investment allowances or deductions. Because I'm very sure once we are good on the basic concepts of tax, when we'll be now introducing the topics as they are, our work will just be flowing. Will just be flowing, will just be flowing, will just be flowing, will just be flowing. So that's the beauty part of us starting with what? That's the beauty part of us starting with basically the concept of the basics. That's the beauty part with us starting with the concepts of the basics. So this will mark the end of this class today, so that when you meet, I think tomorrow we're going to meet. Of course, that will be communicated. So that when you meet tomorrow, basically, I want us to clear capital allowance and start immediately